are going to move to gold now. And the Gold Council released last week their half-yearly outlook in terms of how gold is expected to perform. And joining me now is Shaokai Fan from the Gold Council joins me now. Shaokai, sorry, just had a minor technical hitch there, but we're back on board. Thank you so much for joining the close on AusBiz this afternoon.
Thanks for having me.
Yeah, so you've released your half-yearly report after what looks like a very good half-yearly performance for gold for the first half of 2023. And I think we have a chart there, so maybe you can run us through how it looked in the past, and then we'll move on to some of the drivers in terms of different scenarios for where you see that gold price could move over the course of this year.
Absolutely. Gold, like you said, has had a very strong first half of the 2023 year so far, up about 5% in US dollar terms, up about 7% in Aussie dollar terms, and outperforming a lot of other major asset classes during this period as well. Some of the themes we've been seeing in gold markets in the last 6 to 12 months or so has been very strong buying from central banks. In fact, historic levels of gold buying from central banks, as well as recoveries in other sector like the jewelry sector for gold, as well as investor demand for gold from both institutional and retail investors too.
Yeah, just in terms of that central bank buying, it's really interesting, isn't it? Because the dynamics around, the demise of the US dollar and, these new, I suppose, the world effectively moving, deglobalizing, and you've seen some of those major central banks wanting to move away from, I suppose, a reliance on US dollars, namely China, Russia, for example. Do you think that's been one of the reasons that some of those central banks have been such big buyers of gold?
I think there are a lot of different reasons that are influencing why central banks are so drawn to gold recently. Certainly, the global geopolitical environment, including the future of the US dollar, I think is part of their consideration. But it's not the only thing, of course. There are other factors at play as well. And you mentioned China and some other countries buying gold, but actually a major gold buyer among the central bank community this year has been the Monetary Authority of Singapore as well. I think it's the second largest buyer year to date so far. So it's a variety of different central banks buying for a variety of different reasons. But I do think that, the future of the dollar and geopolitical dynamics are a big part of that conversation for sure.
Okay, but when we go to the outlook, a lot of it seems to depend on what type of economic playbook we're going to see over the second half of this year. So what is your first scenario that you see playing out that might provide some tailwinds for the gold price?
Yeah, thanks for mentioning our mid-year report. We basically looked at three different scenarios, and I'd say our base case is that the Fed and other major central banks go into more or less a holding pattern on interest rate hikes, and then we maybe go into a mild recession, as most Wall Street analysts are calling for, later this year, early next year. In that scenario, we think that the gold price will remain supported, but it's unlikely to break out of the current range that we're in as well. I think that that's probably the base case we're looking at, and probably the most consensus case among analysts as well.
Absolutely. But what happens if we actually get a recession in the US and we get a scenario where real yields start to come down, or a case of they start having to drop rates at the short end?
Yeah, I think that that's also a possibility that we examined in our report too. If we go into a more severe recession, I think there's more of an upside for gold because recessions often entail volatility in risk assets, and also maybe a reverse of rate hikes that we've been seeing from central banks and monetary authorities. Historically, gold has done well during recessions. In the past 10 recessions or so, gold has definitely performed well during most of them. And also, I think it's a good opportunity for your viewers out there to take advantage of gold's hedging abilities, its risk-off capabilities, as equity markets have done well recently. But if we head into a more recessionary environment, we think that gold is a good tool that can help dampen volatility. So, now is a good time to consider adjusting your portfolio for that scenario too.
If we get a higher for longer interest rate scenario and really, really sticky inflation, because investors often say, you know, gold's a great hedge with inflation, but is that truly the case if we do see central banks having to continue to hike?
Gold has historically done well during periods of inflation, but it's really outperformed during periods of hyperinflation, which is not quite what we're seeing right now. And you're right, if we have a scenario where interest rates remain higher for longer, then I think that would present headwinds for the gold market as well, because of course gold has no yield, and that would raise the opportunity cost for gold.
Have you looked at the gold price in different currencies? Someone actually pointed out the other day that because the Japanese yen has been so weak against the US dollar, that the yen denominated gold price has actually been one of the top performers. Do investors ever look at it that way?
I think they do. Certainly, local market investors look at gold in their own local currency. And you're right to point out Japan. Not only has gold reached new highs in yen terms, but Japan is experiencing inflation for the first time in 30 years or so. So I think it would be very interesting to look at how Japanese investors react to a scenario they haven't seen in 3 decades, basically, and whether they'll turn to gold as a way to retain their spending power by combating inflation.
Absolutely. So, in terms of some possible price targets that you're looking for in US dollars, maybe you could share some of those with us.
So we don't forecast the gold price itself because of regulatory restrictions, but we do have a lot of tools available on our website that you can use to simulate future gold demand and supply and therefore extract a theoretical price based on those simulations. But I think our mid-year outlook did present a lot of different scenarios, the base case of which is that gold more or less remains supported but range bound if we go into a mild recession with central banks more or less holding firm on the current interest rate levels.
Okay, if we just step back slightly in terms of the main demand drivers, if you had to pick one, whether it's jewelry demand or central banks or interest rate settings in the US dollar, which are the main kickers in terms of moving the gold price around?
Certainly, in terms of the everyday impact, it would be interest rate levels, the macro forces, and of course, if there are risk-off events that happen on that day, that would create sort of major intraday changes in the gold price. But in terms of the long-term impact on the gold price, it would be, these longer demand cycles like growing growing economic performance in India, in China, for instance, more spending power by retail consumers in those types of markets. And then, of course, the central bank buying has been such a big part of the gold story in the last year and a half. So I do think that that's been an impact in the gold market as well and been supportive of the gold price recently, too.
Do ETFs, because a lot of investors gain exposure through a passive instrument like an exchange traded fund, do they are they one of the larger demand drivers as well when you see investors looking to position rather in that passive way rather than buying physical gold?
Yes, absolutely. ETFs are a very big part of the gold market these days and a very important part. I think the total amount of gold that is held through ETFs is now larger than the amount of gold held by the German central bank. And it just is a much easier way for most investors to gain access to the gold price because they don't have to worry about the physical elements of managing their gold. So, yes, definitely a much bigger part of the gold market today than it was 10 years ago.
And in terms of portfolio construction, obviously you can't give recommendations, but if investors are looking for, I suppose, hedging away some of, that risk if we have volatility, is it a case of maybe sort of 5% of a portfolio should go into a form of gold?
So we've done a lot of analysis on the impact of gold in various types of portfolios, whether it's retail, institutional, central bank level portfolios. And generally speaking, almost every type of portfolio benefits a little bit from having gold. It produces higher risk adjusted returns. There's no one specific gold allocation that's right for a general audience, but 5%, 10%, that type of allocation seems to do well for a lot of the institutional portfolios, and central banks look at other factors as well. We have produced research specifically for the Australian market, so I think that might be very interesting for your viewers to take a look at. But we think that almost every portfolio can benefit with having a little gold in it.